Huobi Technology Holdings Limited is a company with a global vision, active in the development of blockchain and virtual assets ecosystems, and is committed to becoming the leading one-stop virtual asset service platform in Asia. With comprehensive licenses, Huobi Tech is aiming to form a virtual assets closed-loop ecosystem that integrates cloud services, data center services, SaaS, asset management, trust, custody, brokerage, and exchanges.
Hi, everybody. Well, the crypto industry has grown absolutely phenomenally over the past 12 months. But at the same time, regulatory scrutiny has been climbing very rapidly. Watchdogs are interested in everything from potential fraud to money laundering and consumer protection. And it's becoming one of the absolute hottest topics in crypto. So we've assembled a group of crypto specialists and investors to sort of talk about the investment angle here. I'm Adam Samson, the market news editor at the Financial Times. We have Lily Zhang, who's the CFO at Huobi Technology, Raoul, the CEO at Real Vision Group, and Ari Paul, the co-founder and CIO at BlockTower Capital. So I guess one of the sort of really key questions here is the balancing act that regulators need to do. You know, they're obviously very, very keen to sort of kind of get rid of this Wild West mentality that took hold in crypto over the years when it was largely unregulated. But at the same time, not stifling innovation. And so I'd be very curious to know your views as people actually involved in the industry on the best way to sort of do this balancing act. So it'd be great to start with you, Lily, if you want to talk about your perspective a little bit.
Thank you. It's my great honor to talk with you. Actually, this industry has a very short history, just over 10 years, maybe just like internet in the 1990s. So and in the past 12 months, the industry experienced the largest expansion, both in numbers of customers, maybe the players, and also the total assets amount. It's not very hard to understand why regulators have many concerns about this industry, so new and so quickly expansion. From our perspective, you know, Huobi Group was founded in 2013. We are a very long-term player in this market. We are very happy to see that. And in my opinion, ignorance means risk, and regulation means regular. If no one cares about this industry, no regulator pay attention to this industry, it means you are not important. You are not big enough. You cannot change this world. You cannot influence enough people. So I think today, regulators, they pay attention to this industry. This is a very big signal, especially to us, very early stage players. We have made so much progress in this industry to let people know what's this industry, what we are doing, and what will be the next. And today, so regulators come in. We want to do very good cooperation with them. But yeah, you know, since this industry has so short a history, it's very difficult for regulators to know enough knowledge about this industry. So we are trying our best to do so much work in different areas, especially we are exchange background. It's very important for regulators to know what about the money laundering, what about DeFi regulation next, and what about institutional players in this industry that they pay attention to. So in the past maybe 3 years, we try our best to cooperate with different country regulations. We are very happy to see many countries, maybe like US, is quite open to this industry. But there are also many noise or voice. For example, for ACC, they have their opinion. And for many different departments, they have their opinion. We want to work with regulators together to make the regulation more and more clear and more open and more positive for this industry, because it's in a very, very early stage. We will take a very long way to go. And maybe 10 years ago, when you see today, okay, although it's experienced the largest expansion in the last 12 months, but it's just a very, very early beginning. Yeah, thank you.
That makes a lot of sense. Thank you. You know, Raoul, you were saying on Twitter, I think just the other day, that there sort of needs to be some sort of grand compromise with regulators. And I think that sort of hits on some of the points that Liu is making too, about how the crypto industry needs to sort of be in conversation. It'd just be great to hear more about your thoughts on that subject.
Yeah, the reality is the regulators have a lot of work to do because they're so far behind. This is the fastest adoption of any technology in all human history. So it's currently growing at about twice the speed of the internet, 113% a year in terms of number of users, where the internet grew at 63% when they were both at 150 million users. So as Lily said, we're at basically the internet in 1997. The regulators struggled back then, and it took a while to draft laws. Now, the issue is we want regulation because that will also create further adoption from the institutions. But if they create the wrong regulation, they're going to kill what is the fastest growing industry the world has ever seen. So that's a huge problem. And the issue is right now, Gensler is making it very clear that he has a particular hard line on what is a security. And that's what the whole debate is about right now. You know, KYC, AML, that's already being onboarded by everybody worldwide. So that's no issue. It's about what is security. So what is that discussion about? That is about a 1933 and 1934 securities law, which doesn't really make sense now. Additionally, that securities law is so onerous on businesses and innovation that it stifles it, which is why everything is in the private sector in Silicon Valley. You know, the VC world is so big, is because people can't deal with the regulation of listing shares. And they can't apply the same framework around tokens, these digital assets, because they are different than securities. They share many of the same attributes as securities. And I don't think anybody's going to get away without saying they're securities. We're just going to have to redefine what it means to be a security, because we don't really care what it's classified as, but it needs to be something that is workable, that allows this ridiculous pace of innovation that's changing the world, but to have a framework that avoids some of the fraudulent activity. Consumer warning should be there. I mean, we could all go and lose money in a casino in Vegas. There is no regulation. I can go and bet everything I've got on one spin of the roulette table, and there's no regulation. But for me to buy an early stage token might now be wrong because it's security. This whole thing doesn't feel right, and it doesn't play into the hands of this rich-poor divide that we've seen that's been so strong. Is because if you create things that are securities, you basically force only accredited investors to be able to buy them at certain stages. And that therefore means that you're only allowing rich people to get access. There needs to be a compromise in the middle of this, of what this actually is classified as and what that actually means.
Ari, do you agree that that's secure, whether, you know, crypto tokens and other sort of crypto assets or securities is sort of one of the central tenets of the debate about crypto and regulation?
Yes. So under the 1934 securities law, many cryptocurrencies are almost certainly securities. Many are not. So Bitcoin very clearly is not a security. There's no debate. But a lot of these projects that ICO'd, that sold tokens to the public, probably are, or at least were at the time. So it's less a debate around whether they are securities or not. I mean, crypto insiders, especially people who are ignorant of law and regulation, might claim that. But really, I think Raoul framed it right, which is, okay, they're securities under 1934 law. What next, right? Does that mean, so regulators don't uniformly apply these rules, right? So many securities are offered illegally. There's no enforcement. Enforcement is a tiny percentage of, of these issuances, both in crypto and outside. So I think the problem is clearly the enforcement and regulatory framework around that 1934 law is not working. Regulators can't make it work. they are, Gensler is holding these press conferences kind of yelling at people while taking very little action. And he is going to take more action very soon. He said that very clearly. We should expect a lot of enforcement actions around a whole bunch of different things in crypto, but they don't really have the bandwidth. For example, let's use Ethereum. They don't know what to do about Ethereum. It's now a giant, almost self-contained asset class. It's not really an asset class, but it's an ecosystem with huge amounts of activity, many, many billions of dollars of daily activity on it. And to, how do we, it has an incredibly diverse holder base that includes both accredited investors and retail. It has done incredibly well for those non-accredited investors that were in early. So I think the question is, as Raoul framed it, the regulatory framework around this 1934 law just isn't working. And so how do we go forward? I actually don't have a strong opinion on the right approach. What I'd love to see is a fundamental rethinking of that 1934 law and the regulatory framework around it. Short of that, we're probably going to remain in this awkward middle ground of selective enforcement, which feels very unfair and arbitrary and even corrupt. So the problem is, if we look at a marketplace with many, many, many security law violations, and the SEC is going after 1% of the actors, you end up with a scenario where the good actors, the players who are trying to be compliant, they're getting outcompeted. And they say to the SEC, look, you either got to tell us that this is legal for us to do, or you have to stop our competitors from doing it. But when regulators leave this ambiguity and enforce so sparingly, what they do is they ensure that the bad actors will win. The people who pay a lower cost of compliance, the people who cut corners, they gain the market share. They become the dominant market leaders. And the result of that is not consumer protection. So as an example, the SEC's refusal to approve a Bitcoin ETF has driven retail into ETNs, like the grayscale products. So an example of this, for the listeners who aren't familiar, GBTC has something like $40 billion of assets of Bitcoin. It's an ETN that is meant to track Bitcoin, but at various points in the last few years, it was trading at several 100% premium to NAV. Right, so the Bitcoin collateral in there was worth, say, 10 billion. The product was trading at 20 billion, and that means retail was getting ripped off. Retail investors who were buying this on stock exchanges were paying 2 times the fair value. And that was because the SEC wouldn't approve an ETF. So we're in this middle ground where consumers are being very badly hurt by regulators basically penalizing good actors and letting the bad actors flourish.
I guess just to challenge you a little bit, though, maybe just to step back. One of the concerns that Gary Gensler, the head of the SEC, that both of you have mentioned, has is sort of things from, consumer protections. Do consumers get enough information about a lot of these securities? So why is it, if you're both sort of in agreement that these look an awful lot like securities, and it sure seems like they do, some of these crypto tokens provide yield, for instance, in the same way a bond would, or the way their fixed income assets would. What is the pushback in the industry about sort of going down the conventional route and say issuing of prospectus? That clearly defines the risk disclosures and things like that. Why is that a problem?
I think there's a few things. One is asking a startup to spend $1 million in legal fees constructing. This is why companies almost stop going public these days. That's why we have the whole SPAC craze, because Dodd-Frank made it so onerous, so expensive to be a public company that you have companies that are $10 billion companies saying we can't afford this, or it doesn't make sense commercially for us to take on this burden. So one is, when you have an insanely high cost of compliance and you impose that cost on startups, you kill innovation, because there's a lot of startups that just won't get started because people don't want to spend up front $500,000 or $1 million on compliance costs. So you need shorter paths, easier, lower cost legal fees, lower cost compliance. I think that's a big one. Another is the lack of clarity. So a huge number of crypto projects went to the SEC. They said, we want to do a legal compliant offering. We're going to have a prospectus. We're going to limit to accredited investors. This is what we're planning on doing. Can you please tell us that this is okay? And the SEC generally refused to answer. Some of those projects today, let's say we're talking 2017 projects, some of them look like they did it okay. Some that had white shoe legal counsel, right? They were advised by Sidley Austin. They were advised by top law firms. They thought they were doing everything right. And then recently the SEC said, nope, you didn't. So these were projects that tried to be fully compliant. They hired top law firms, and they're now being told, nope, you didn't get it right. What message does that send to people who are trying to be compliant or are hiring the top law firms, right? It produces a freezing effect on the very kind of good actor and entrepreneurs that you want to be building these products and raising capital.
I mean, I guess one of the problems, that a lot of regulators have cited, certainly Gary Gensler, but, globally, many have mentioned this idea that a lot of crypto firms have just sort of gone ahead with a lot of these sort of offerings and other activities. They're sort of asking forgiveness rather than permission. That certainly seems like a big issue here. And Lily, your firm is involved, in a lot of markets. I just wonder whether you think the crypto industry was sort of early enough in working with regulators.
Actually, yeah, this industry is very early. Since I'm CFO of a listed company, and I have before I joined this industry, I brought many companies to be listed, for example, in NASDAQ. Actually, yeah, it takes a very high cost to do this kind of regulation. And for why ICO is popular, or why why crypto is very charming to many innovators, because a token is something we can share. We can share our right to many early stage players. That makes them join us very quickly. So actually, this kind of innovation changes a lot. In many aspects, not just limited to technology, but maybe to something economic cycle. So it's very important to encourage this kind of innovation. If from the first day your regulators say, such as SEC, you're okay, everything should follow like listed company today, I don't think this industry is strong enough or to talk with this kind of regulation. I think since this is a very new thing with a very short history, just maybe like several hundred years ago, the banks industry come to the market. Maybe we should pay some attention, and regulators should pay more patience to this industry. They should maybe make some very different rules to solve this kind of issue. Not just to say, okay, everything should should follow securities. That doesn't work. That will make this whole industry, this innovation, go die very quickly. So we are trying our best to make different innovators to know something about that. Maybe US is a very important market, but then also maybe European market, Asian market like Singapore, MSC, they are very good example. They try their best to follow this industry. They share different kind of license to do different kind of things. I think maybe this kind of thing can make the industry better. You cannot just do the regulation, everything like the past, like a listed company. You should do something new.
Do you all think that, I mean, it seems like you are in fairly broad agreement that there needs to be some sort of specialized crypto regulation. I mean, is there any sense the idea that there should be some sort of global self-regulatory body or some sort of global body that oversees it? Because it's such like a borderless industry.
Yeah, I think there's some merit to that, because this is the first global product that is ubiquitous, available to everybody, and it's driven by retail, right? This is not an institutionally offered product from scratch. So this is a very different beast. It's come from the ground up, and it's truly global, trades 24 hours a day. It has no jurisdiction. So it then becomes, what jurisdiction do you live in as a person? And so that makes it really complicated, and you will absolutely, without question, because this is the network of money and the network of value, if you try and over-regulate in one country, you'll force regulatory arbitrage. And if they want to do this properly, they need to think about that and do it at a light touch, globalized level. Would make some sense, but I don't know that that can be done. Because I mean that would take a decade to negotiate. And then the crypto industry's a $50 trillion industry, a $100 trillion industry. Then what do you do? What, do you go back and fine everybody? I mean, this is the madness of what is actually going on. They're going back and fining people from 5 years ago and saying it's okay, just pay the fine and move on. don't admit any wrongdoing. I mean, that's what they've done to everybody. So the situation is so unclear that, you know, what it is actually doing, particularly in the US, is forcing people to set up the projects in Switzerland, Cayman Islands, Singapore, anywhere where they have a broader jurisdictional understanding of what it is. I mean, the Monetary Authority of Singapore have done a great job deciding how this should be done. South Korea has done a good job. But the US is so far behind because it's so focused on this 1934, what is the security and what it means, as opposed to creating digital asset laws.
Ari, do you agree with that?
Yes, I don't really have an opinion on the self-regulating body idea. I don't see an easy path to that. And I think, Raoul, just to echo the point, the regulators are really struggling with the global nature. And so, I mean, we even see this at a micro element where, for example, the New York AG is suing companies that are outside the country that ostensibly have no connection to the US. And they're suing them because there'll be a few US customers who VPN and access it. So I'm not debating the law. Like, in theory, the New York AG does have jurisdiction if there's a single New York resident on that exchange. But we see the tension where the New York AG is suing a company that's based in, say, Singapore. And under Singapore law, they're doing everything right. They're based in Singapore. It's a Singapore company. It's regulated by Singapore. Basically, you have regulators all over the world trying to assert jurisdiction. And the world's a big place, right? When we have a single US state asserting jurisdiction over a Singaporean company that serves people globally, basically, you're a company trying to operate globally, you have to engage in compliance in hundreds of jurisdictions. That is such an insane overhead. And it's an overhead that never used to be that insane, right? There weren't that many companies that faced this challenge. And the companies that did face this challenge 20 years ago were giant multinationals, right? Companies like a Microsoft or a GM or a GE that can pay 20 million a year in compliance costs. So I think, yeah, basically, I'll expand the scope of the question a little bit. We're entering a borderless world where money, whether governments like it or not, you can now have hundreds of billions of dollars cross borders instantly, where technologically there's no real way for governments to prevent that or even to track it. And so they're kind of trying to preserve an old regulatory climate, even though the physical reality has changed. And that's creating a lot of this cognitive dissonance and problems. And I don't know, I don't have a simple solution. I don't have an answer.
And the other thing to bear in mind here is they're still looking at protocols. That's where the regulators are, is Solana a security or not a security? Meanwhile, DeFi, thousands of projects. Meanwhile, NFTs, tens of thousands of projects, and then social tokens are coming as well. So within this industry is moving so fast that give it another 2 years. And well, if you extrapolate the rate of change, you'll have 1 billion users by 2024. And the range of products is vast. What are you going to do? Go back and penalize 500,000 projects? It can't work that way. It just can't.
I mean, I presume we probably have a bunch of traditional finance people in our audience, and they may be saying to themselves, we have to spend a huge amount of money on compliance staff, compliance systems, all this. I mean, why shouldn't crypto companies and sort of digital asset
the question is why should they be regulated so tightly as well? We've seen the crowdfunding rules change, for example. There is an ability to start changing how that is done. We've seen the rise of SPACs. That's telling regulators you are you're creating excessive burdens on us to go public. And that also means that if your job as a regulator is to allow for participation within financial markets, you're not doing your job, because right now, as Ari said, is all of these giant unicorns are not going public because they can't. So that makes venture capital firms and wealthy individuals get access. They allow them to have access, and the retail investors end up buying it when the thing is now worth $50 billion and is trading at a P of 50. This is not fair.
The other flip side of the regulator's job, though, is very much to protect consumers. So what can crypto companies do better on that side? I mean, there very clearly are serious issues there with consumer protections. I mean, it seems like an indisputable fact, basically.
Oh, sure. I mean, there's huge amounts of fraud in the crypto industry. There's outright scams. There's absolutely a lack of transparency. Investors get hurt all the time. So I don't think anyone on this panel would debate that statement. The question is really, is the cure doing more harm than the problems themselves? So nothing that regulators have done have prevented those scams. So penalizing Coinbase and making Coinbase have 10 times the compliance costs and a much slower development cycle does not help prevent the outright scams. You're penalizing the good actors. Now, I think that to answer the TradFi question, why are banks happier with this than crypto? Banks write the legislation. So, we all know about the revolving door of lobbyists and regulators and bank partners. The banks are constructing regulation that enforces an oligopoly, right? So you can't start a small bank in America today, almost at all. I mean, the big banks are hoovering up small local banks because compliance, being a small bank in America is almost not commercially viable. It's certainly not attractive. And so we're seeing the big banks get bigger, the small banks kind of gradually getting hollowed out. And of course, much of traditional finance likes that, right? Because you're entrenching oligopolies that prevent competition. So it's like, I'll speak personally as a founder of an asset management firm. In another few years, my commercial interest will probably be to push for more onerous, adverse regulation to entrench my own lead, right? So if someone's going to start a crypto asset management firm and they say, man, I'm going to be paying $2 million in compliance costs a year from day one, I'm not going to bother. That's great for me once I'm established, once I can afford to pay those compliance costs. So the issue, and I do think that's going to follow, I hope that doesn't happen in crypto, but my assumption is it will. Basically, crypto is doing the same thing. Crypto is, firms like Ripple are hiring former senior regulators. Many top leading firms are hiring senior regulators. They're lobbying for custom legislation and regulation that will ideally help the industry, but in practice often helps the specific firms that already have a lead. You asked a question about why are people asking for forgiveness, not permission? The single biggest reason is if you ask for permission, you don't get an answer. So, and I mean that very literally from a few different perspectives. So projects that ask the SEC, we think we're doing this right. Sidley Austin, is back, or Sherman or whoever, one of the top OIG law firms, can you confirm this? They just don't answer. But beyond that, custodians, for example, that apply for a broker-dealer license, that apply for the proper regulation, often have to wait 18 months to get approved. We saw what happened with the Bitcoin ETF, right? We've had, 15 proposals. We're still waiting on the SEC. So the answer is you can either ask for permission, go through the regulatory process, and potentially be years late to the market, right? You'll have competitors that have established billion-dollar businesses by the time you get that broker-dealer license. Or you ask for forgiveness, you risk a slap on the wrist fine 5 years later. If you hire the right regulators, you do the right things. Let me put it this way. You can't compete in a fast-growing, fast-changing industry asking for permission if regulators take years to respond to that request. It just doesn't work. So what happens is the market leaders, the billion-dollar companies being built, are the ones that didn't ask for permission. Or asked for permission and just went ahead when they didn't get an answer. And that is the right commercial strategy enforced by regulators. So you look at a company like Coinbase, it's publicly listed now, right? I don't know what the current market cap is, but it's a $50 billion company. If they eventually end up paying $1 billion in fines, that was still the right commercial choice for them, right? Basically, playing cautious means you lose under the current rule set. And that's not good for anyone. That's not good for consumers.
And that means the US loses, right? You've got a new technology like the internet that's growing even faster. And if the US persists with this particular way of regulation, they will lose the industry. And considering the US is the world's reserve currency and the financial powerhouse, this is not an industry you want to lose. There's a big battle line here. You need to win this, much like you had to win the internet. There is no choice.
Yeah, I mean, sorry, Lily, go ahead.
Well, actually, for a very long-term crypto player in this industry, I think we do maybe three things. No any complying to many regulators. First one, yeah, it's very important. Crypto assets is no country limited. So just like, yeah, they mentioned, if US lose, maybe other country they will again. So we try our best to have communication with more regulators, not limited to US or China or Singapore, many countries. So we have a very large regulation team, maybe based in different countries. We try our best to let different regulators know what's happening in this industry. Maybe some countries, they become more open to this industry. That will help other regulators to know everything better. And the third one, we must try our best to do some regulated business. For example, we always try to build up our KYC team, money laundering system, and maybe custody, many things to make our customer, make regulators feel safe. Feel, okay, we are trying our best. And the third one, very important. It's very difficult today in a very early stage to avoid many criminals in this industry. Many projects or some people will use this technology to do something wrong, to do something bad. So that's very important for us, especially very early stage players, to educate players, educate newcomers to this industry, make them know, okay, you cannot just look at money. You cannot just look at, okay, if I buy some crypto, I will earn a lot of money. You must know the risk. What's this industry really like? So I think we are trying our best to do such kind of thing.
I think that third point you mentioned is a really good one. I mean, how much the responsibility should fall on the exchanges and traders and other asset managers for sort of protecting the broader ecosystem? You know, for instance, making sure that coins that are potential Ponzi schemes, things like that, aren't listed on major exchanges.
The issue is who makes that decision, and what makes you.
I guess that's my question.
Yeah, the difficulty is who makes that decision. Now, there's an easier way, I think, which is much lighter touch, which is assume that everything over a certain market cap size is freely available to anybody. Then anything small comes with a risk warning to say, you have to do your homework on this, and you have to understand whether this is a legitimate earlier stage project or not. And something like that, much like you do when you take out a loan. You have a cooling off period. Maybe you can't have a cooling off period. Maybe you can with this, but something that puts the burden on the individual to understand the risk they are taking, as opposed to the voice of God saying, you shall not trade this token, but you shall trade this token. That's impossible in a space growing this fast.
But surely this is exactly what happens when you go to sell a stock. I mean, you do a prospectus, it has risk disclosures. I mean, isn't that what you just described?
Much lighter touch than that, because you'd have a pop-up on the exchange that would say, if you're about to trade your stock, you understand it's a small speculative stock, etc., etc. Much like you do when you trade options. You don't have all of this offering when you want to buy an option. You don't have any of this. You can pretty much do what you want. And we've seen that in Robinhood. So what you need to do is explain to people, this is a risky thing. It's okay for you to do it, but understand the risks. The prospectus, that makes no difference. There's so many corporate frauds. I mean, there's a whole industry of short selling based on corporate frauds. So that doesn't work either. It's got to be, caveat emptor. There's the only way that this applies here, with some guidance from the people who have more knowledge of the space and some simple blanket rules.
I think this is almost a branding question. So like if we think about stocks, getting listed on the NYSE lends credibility, right? So investors assume if something is listed on the NYSE's done some homework, some diligence, and therefore a stock generally trades up, right? If when investors start pricing it up, if they think it's going to be listed on the NYSE. Whereas a pink sheet, we kind of know is buyer beware. I think we're going to see the same, and that's kind of, we can think of that as almost very light self-regulation, where and we are seeing that. So you have exchanges that are branding themselves as the more regular, more compliant, more consumer oriented, more conservative, and they'll build a brand for themselves, and investors will, some investors will flock to that. They'll say, I trust the New York Stock Exchange. I don't trust random pink sheets. But there's so much demand for offerings beyond that we can't wish it away. So the problem that, and I think this is kind of, again, similar to whether it's Reg A Plus and crowdfunding offerings. Basically, you can't say, imagine if the regulator said you're only allowed to trade stocks on the NYSE, nothing else. it wouldn't work, right? So the VC industry would just move to another country. There's basically, you have this fundamental demand to invest in things that aren't whitelisted by a single entity or a few entities. And so you get a bifurcation. You get the legitimate, trustworthy, safe brands. So we can think about the same as in banking, right? So you have a JP Morgan or the people view as whether right or wrong, they say, I can just trust JP Morgan. I don't need to look at its balance sheet. I don't need to diligence it. I don't need to look for fraud warnings. It's just JP Morgan, right?
We can say that partially though, because, you know, there's lots of regulators who are looking at them, who are stress testing their balance sheet, that kind of thing, right? I mean, so are you saying there should be sort of like I don't know, like a bulge bracket of crypto?
I think it happens organically due to market forces, and regulators play a small role of lending extra credibility, lending kind of brand support. But using our example, right? We saw in 2008 that regulators didn't really even understand the balance sheets of some of the entities. That, you know, you had $100 billion stuff hidden in footnotes, and it certainly. I mean, aside from FDIC insurance, there's really no protection, right? It was kind of a myth, like, right, we were all talking about, is this too big to fail? Is Lehman really too big to fail? So I think the way this plays out is you'll have some exchanges that carve out this niche. They get a little bit of extra credibility by going through regulatory compliance, and investors know and trust that the offerings there are relatively high quality. But you're still going to have this demand for pink sheets, and so you'll have these exchanges that offer the rest. Now, what's interesting about cryptocurrency is increasingly there are DEXs, decentralized exchanges, that cannot be regulated directly. And users will be able to buy tokens on those decentralized exchanges as long as the internet exists, as long as users within a region have access to a public internet. There's no way to physically stop them. And the offers, the sellers of those securities are increasingly pseudonymous. It's increasingly anonymous teams. And VCs are not holding that against them. I mean, Bitcoin, of course, had an anonymous founder, and that's become almost a mark of pride, including among VCs who are increasingly allocating. I mean, these are regulated US-based brand name VCs that are allocating to pseudonymous teams because they understand that there is a legitimate reason to be pseudonymous today. There's a legitimate, it's very similar to a SPAC. We understand that it used to be that if a company did not go through the direct NYSE listing process, that was a red flag, right? If you got listed on a Canadian exchange, the assumption was you're not good enough. That's not the assumption anymore. Now we understand that a company may have chosen to list on a Canadian exchange or chosen to go public via SPAC, not because it's a red flag, not because it's a fraudulent company, but because the burden of doing the direct NYSE listing is just so insanely high. So I think we're going to get the same thing. We'll get a bifurcation. We'll get brand and regulator credibility, so investors that are a little more conservative can lean on that. But you still have to deal with this long tail, and there's no way to directly regulate it.
There's another way that could be done, which is to say, okay, if you're going to trade if you're going to invest via a US exchange, you need to pass a relatively simple exam to give yourself a license to invest. So then it's back on the individual to say, well, if you want to trade in this stuff, you need to understand what it is. And then
this actually relates to a question actually a couple of people in the audience have asked, and we only have a couple of minutes, so I just wanted to bring it up, which is that, can you integrate some of this compliance stuff directly into the technology?
You can, and many are. There are many protocols doing exactly that. They're integrating fairly complex travel rule type, and that's being worked on right now. There are some protocols that already have it up and running. So I believe some projects like Hedera, for example, have some level of integration. I don't know if it's going to meet the upcoming standards coming out of Europe, but it's certainly, there are no technological impediments to doing that, to my knowledge. The problem, so what that's going to produce, what it's already producing, is frankly very similar to the banking system, where we have a bifurcation between white listed and gray money, right? So we have an AML KYC system in traditional finance, and obviously we have a huge amount of US dollars outside of that AML KYC system. And then we have a giant gray market industry that effectively launders that money one way or the other. And often it's legal laundering. It's not necessarily, I don't mean to imply that it's illegal. So we're going to see the same thing in crypto, where you're going to have whitelisted addresses, AML KYC tracking with customer identity with every transaction. But obviously, a lot of people around the world are not going to want to be giving up all that information, particularly to governmental entities that can't keep it private, right? So what was it, 6 months ago, many US government databases were hacked. So critical health information, the personal addresses and social security numbers of military vets were all leaked. They're all publicly available. Basically, if you want the social security number of any military vet from the US, you have it. And so it's very rational for a resident of Singapore to say, I don't want US regulators having all of my personal private info when I know that's very likely to be rendered publicly available. If you think about it, it's even of questionable legality, whether that should be possible, right? If we know that these databases are not secure, is it reasonable or fair to accept people all around the world to be turning over this critical sensitive information to US regulators who can't safely control that information?
Lily, I think I saw you shaking your head there. We don't have very much time, but did you have something you wanted to add?
Actually, I think this industry is quite or extremely technology driven and professional finance driven. So maybe that's why I think, for example, professional investors, for example, asset management, they will have a big opportunity. For many consumers, it's impossible for them to understand what's the basic technology inside, what's the professional financial background. So it's very important to have the very big brand, have a very long, reliable history, and also, to find your professional partners, like some very big asset management, big name. Yeah, that's very important. I think that will be in the next few years. Maybe today, not everyone accept that, but maybe just in 3 to 5 years, most of people will choose this kind of ways.
Well, I think that's a very good note to end on. Really fascinating conversation, and I really appreciate all of your time.
Thanks very much.
Thank you, everyone.
Thank you. Bye.